Today, we will talk about the enterprise value to revenue multiple, EV/R. The enterprise value to revenue multiple is a measure of the value of a stock that compares a company's enterprise value to its revenue. EV/R is one of several fundamental indicators that investors use to determine whether a stock is priced fairly. The EV/R multiple is also often used to determine a company's valuation in the case of a potential acquisition. It's also called the enterprise value to sales multiple. The enterprise value to revenue multiple helps compare a company's revenues to its enterprise value. The lower the better, in that, a lower EV/R multiple signals a company is undervalued. Generally used as a valuation multiple, the EV/R is often used during acquisitions. An acquirer will use the EV/R multiple to determine an appropriate fair value. The enterprise value is used because it adds debt and takes out cash, which an acquirer would take on and receive, respectively. The enterprise value to revenue is easily calculated by taking the enterprise value of the company and dividing it by the company's revenue. The enterprise value formula includes components such as market capitalization, debt, and cash equivalents. Another method of calculating enterprise value includes additional variables such as preferred shared capital and minority interest. A real-life example can help illustrate EV/R. For instance, consider the enterprise values of Walmart, Target, and Big Lots, which are $433.9 billion, $79.33 billion, and $3.36 billion, respectively. Meanwhile, the three have revenues over the trailing 12 months of $534.66 billion, $80.1 billion, and $5.47 billion, respectively. Dividing each of their enterprise values by revenues means Walmart's EV/R is 0.81, Target's is 0.99, and Big Lots is 0.61. The enterprise value to revenue looks at a company's revenue-generating ability, while the enterprise value to EBITDA, EV/EBITDA, looks at a company's ability to generate operating cash flows. EV/EBITDA takes into account operating expenses, while EV/R looks at just the top line. The advantage that EV/R has is that it can be used for companies that are yet to generate income or profits. The enterprise value to revenue multiple should be used to compare companies in the same industry, and as a benchmark of the ratio from best in breed in the industry to know whether the ratio represents a good performance or poor one. Also, unlike market cap, which is readily available on the likes of Yahoo Finance, the EV/R multiple requires calculating the enterprise value. This requires adding the debt and subtracting out the cash and could involve additional factors if using the expanded version. Here are three key takeaways. 1. A measure of the value of a stock that compares a company's enterprise value to its revenue. 2. Often used to determine a company's valuation in the case of a potential acquisition. 3. Can be used for companies that do not generate income or profits. Hope this would help. Thanks for watching.